Hey Eric, happy Monday.
Happy Monday. How was your weekend, Christy?
It was great. The weather was absolutely beautiful. Did you do anything fun?
Me and my wife got to go for a walk near Alum Creek, which is super fun. I love the park there. It was a beautiful weekend. So aside from that, just relaxed. It was a great weekend for sure.
Awesome. Yeah. So on Friday, we kind of talked about what a credit score is, how to increase it if necessary, and what it means when it comes to buying. So today's topic is the next step. Eric, I'm a buyer and I think my credit score is good. What is the very next step?
Absolutely. Next step would be to get a pre-approval letter. This is essentially a letter that says that you are, in fact, good to go to purchase a house in a price range that you can afford. Now, the pre-approval process, it can range from lender to lender, but in general, you want to start by talking to a qualified lender about
Like you?
your, like me, right? like about your mortgage options that you qualify for and about a mortgage application. A pre-approval really consists of three things between all lenders. It's going to consist of a credit inquiry, so they're going to look at your credit scores to determine what those are and to determine your credit report and your credit history. They're going to look at your income, so your employment, where you've been working over the past few years, and how much money you're used to making, how much money you're making now. And then they're going to look at your assets, what you're bringing to the closing table. They do this to prevent money laundering because of mortgage regulation today as it pertains to using sourced funds for closing. So they're really looking at the three things that we can control up front. The fourth thing that is used for loan approval is the property itself, which we won't get into until you actually find a house, and that's when they'll be talking to you, of course.
Yes,
Um, but
definitely.
the but the first three things, the credit, the income, and the assets, those are what we really look at. So we start with a mortgage application, which is basic questions about where you live over the last few years, where you've worked over the last few years, a couple other basic regulated questions. And then we take down your income, your assets, pull your credit report, and we ask for all your documentation as it pertains to your income and assets. Specifically, if you're, wherever your income may be coming from or your assets being used for the transaction, wherever those are coming from, that's the documentation that we ultimately require. So we document both your income and your assets. We put your credit report, and that's going to allow us to determine how much you qualify for, which we'll talk about in a minute. But it'll also allow us to issue that pre-approval letter that says that you're good to go to purchase.
Okay, awesome. That all sounds good. And so, how does the borrower know exactly how much they qualify for? Like, what is there a ratio or?
Yeah, great question. There is what's called the debt to income ratio that is based on monthly cash flow. So really, at the end of the day, between all lenders, again, all lenders have a little bit different guidelines for this, but in general, most lending institutions will require that the new mortgage payment that we do for you and anything that's on your credit report, meaning the minimum monthly owed bill, so on your credit report, those two things, again, a new mortgage payment, anything on your credit report, we add that together and we're going to compare that number to your income. So if, for example, the new mortgage payment that we're doing for you and your car payment and the minimum owed on your credit cards each month, if those all equal up to $2,000 and your income is $4,000, that would be a 50% monthly cash flow or a 50% debt to income ratio. Typically, lenders' qualifications for this range anywhere between 43% all the way up to about 56%, just depending on the loan product that you're using. And, again, just depending on the lending institution that is giving you the money.
That sounds great. We don't want any subprime lending like we saw, a few years
Absolutely.
back. We don't
Absolutely.
want anybody to be house poor. That a lot of people will ask me, what's the, upper limit? And I'm like, okay, we'll go talk to the lender first, but you don't want to be house poor. You don't want to be spending everything that you make per month. So,
Absolutely. That's a really, really good point. I think that it's really important to distinguish between, what you can afford based on what the rules say that you can afford and where you really want your monthly payments to be. My team and I take a really consultative approach where we're going to structure mortgage options based around your goals. And that is how much you want to put down, how much you are looking at as far as price point goes, but also really, and most importantly, how much you want to spend per month, where you want those monthly payments to be. Because if you tell me I've got this much to spend and I want my payments to be this much per month, I can kind of structure the purchase price for you, and we convey that then to you as the realtor, and that allows them to understand really what price point to start looking in. So I think that's the more important question, not how do I know what I qualify for, but really how do I know what I should purchase? And that's where you want to work with a lender that is taking a consultative approach in structuring mortgage options to you and your family, and not just structuring mortgage options that you may qualify for, because those two things could be very different.
Yeah, I actually have, have had buyers in the past come to me and they say, I don't know how, but my husband and I qualify for $700,000, but we want our monthly payment to be $1,200 and we have a 5% down payment. And I'm like, did your lender not have a conversation with you? So it definitely helps to talk to somebody like Eric, a real person, number one, not, some of the other unmentionable companies.
Right.
It definitely helps to have that consultative approach and have somebody like Eric that you can, really just talk to and have a conversation with, because, that doesn't match up if you're, qualified 5% down, for $700,000, but you want your monthly payment to be $1,200. So, and that's kind of where I come into is, once I hear from Eric what the pre-approval amount is, and then I actually have a conversation with you as the buyer about what you want your monthly payment to look like. We can kind of back it off from there. And then, we'll talk about kind of what you're looking for in a home. And then I set you up on a home search. If it's your first time purchasing a home, we go through the entire buying process. I know I have a lot of people who haven't, bought or sold real estate in 5-10 years, and it changes as it changes every 1 year, if not more. So definitely good to keep, up on the information that, we have now. So even if you have purchased and sold homes, we can do a Zoom consultation like this, or I'm happy to meet at my office. Or if you prefer, we could meet, somewhere like a Panera. So, and then, kind of go over the entire purchase contract. That again does change yearly as well. So, and that pre-approval letter, very important that Eric was mentioning. The seller doesn't really know how much you qualify for unless you have a documented statement, that shows your down payment. Obviously, more is better if you have it. But yeah, you could say, hey, I want to buy your home, but if you don't have any proof, then, why would the seller take your offer? So if somebody's pre-approved and you're not, they're probably not going to look at your offer. So.
Very, very true for sure. Now, our pre-approvals, once we issue those are good for basically 120 days, because that's how long your credit report is good for on file. So Perfect. It gives us really like 4 months to find you a house and put you in a house once you're pre-approved. Now, if you're looking to purchase, let's say in 6 months or 8 months, it still is going to make sense to get a pre-approval letter so you can hone in on that price point, and hopefully hone in on the neighborhood and hone in on the mortgage options and what your payments will be, and really understand all that, because that stuff's not going to change too much, but it's also going to allow us to structure all that now. And then as more homes come available, and as you get closer to your deadline, it's going to allow you to be in a really, really good position, so that if you want to purchase in that many months, you have everything you need lined up, ready to go, and it's all done with ahead of time.
And another thing too that I don't think people realize, which is usually one of my first questions when I meet with a new buyer, if you are in a lease, are you month to month? If you can't go month to month, or you don't know, just ask your landlord or look at your lease. I have had a few clients, who get the pre-approval letter and they end up buying earlier because they can break their lease. So like Eric said, it's definitely a good thing to at least talk to Eric, but I also recommend getting the pre-approval letter, even if you might not buy for 6 months to a year even, because then number one, what your credit score is, number two, what your purchasing power is, number three, if there's any collections on your account. So you're already there. So all you have to do is reach back out to Eric in 6 months to a year and say, okay, now I'm ready to buy. Worst case scenario, you have a pre-approval letter in case you find something you like tomorrow. So
absolutely. Yeah, that's a great point for sure.
And then what about interest rates? I know that they fluctuate. They've gone down obviously in response to COVID and the economy, but they may go back up. I've heard different things, but how does somebody lock in an interest rate and guarantee that that's what they're going to close at?
Yeah, great question. So first and foremost, interest rates are based on the trading of mortgage-backed securities. I know that's a kind of a technical thing, but ultimately, like you said, rates are going to change every few hours, every single day.
Mhm.
And we as a company can do what's called lock and shop, meaning that you can actually lock at pre-approval. Right now, we're in a rising rate environment, and we feel that interest rates are, and the Mortgage Bankers Association and the Fed has said, that rates are going to continue to go up over the next year and a half. So, not that this is earth shattering or that they're going from, current ranges up 10% or anything crazy like that, but we do know that rates are on the rise. And we do know that if interest rates are going up, it's going to make sense to lock as early in the process as possible. Now, realistically, it makes in our market right now because it's so crazy and because it's hard to go into contract. Like you might make a lot of offers and not end up going into contract.
Mhm.
At the very latest, you want to lock when you go into contract to purchase your new house. So once you're in contract to purchase, once the signed contract is executed and the ink's dry on the paper, that's when you can lock in your rate for sure. That's really the latest time I would recommend locking in your interest rate as well, so that you are, safe and secure and locked in before, closing and all the way through your closing and funding date.
Awesome. And how does that work if somebody is to use you for the loan for a new build home? How does that interest
Great
rate look?
question. We do have long-term rate lock options available. We have long-term rate lock options available all the way out to 6 months. There are some longer terms out there, but in general, 6 months is typically the time frame from breaking ground to a house being completed in our market right now. So I know some places are a little bit further out from the start date to the groundbreaking date, but in general, 6 months is the longer term rate lock options that we have for new builds. So if you wanted to lock in now, if you were in contract to build a house and it was going to be ready at the very end of the year, you could actually accomplish that.
Awesome. Great. Well, thank you for all of that information. Was there anything else that you wanted to discuss today?
The last thing that we mentioned earlier about the pre-approval process, a lot of lenders will say, the first thing that you do once you go into contract is get your loan underwritten. We wanted to take the approach where we actually started doing the underwriting ahead of time. So
Oh, yeah.
we've rolled out this in Central Ohio very recently, but we're going to be underwriting all of our pre-approvals. What this means is you don't actually use a pre-approval letter anymore to put in offers. You can use what's called a loan commitment. And it's basically the fact it just says that your loan has already been approved for credit, for income, and assets. Since we get that stuff anyways during the process, we get your loan approved by an underwriter ahead of time. That makes your offer a lot more competitive in our market. So we started doing that. It's been very successful, and you can
Awesome.
definitely call us to get that process started now to help you go into contract. If you're out there and you're losing offers, or if you're making offers and you're just not getting into contract, this is one more competitive advantage. Definitely call Christy because she's got a bunch of things that she can do to help your offer be more competitive as well. But in general, this is one of the things that we can do as a lender to get kind of the legwork done ahead of time and show your sincerity and ability to lend to the sellers in a much better way.
That sounds great. I mean, if a an agent and a seller have two offers and they're the same price, one has a pre-approval letter, one has a loan commitment, I would sure take the loan commitment if I was a seller.
Yeah, legwork's already done. So
Awesome. Well, thank you for your time today, Eric. And tomorrow we will be covering the money that is needed for purchasing a home because it's not just the down payment, is a little hint. So we will see you guys tomorrow.
awesome. Thanks, Christy.
Thanks, Eric.